Welcome back to The Explainer. Today, we're diving into a pretty wild contradiction playing out right in front of us in the market. We're going to decode a real mystery surrounding one of the biggest, most dominant companies on the planet, Amazon. You see, their stock actually just took a hit, dropping despite absolutely booming growth in their AI and cloud computing sectors. It's a massive paradox, right? Wall Street is buzzing about it, and to really understand what's going on, we've got to look way past those surface-level headlines. Let's get into it. So, on August 20th, 2026, Amazon stock saw a meaningful 2.16% drop. Now, sure, during a broad market sell-off, that might sound, fairly ordinary. But here's the thing. This pullback actually left Amazon lagging about 8.5% behind its recent 52-week high. So the stock is taking a very noticeable dip, and it's leaving a lot of investors scratching their heads, wondering, is this just a brief moment of weakness, or is it a glaring warning sign? But contrast that pullback with this absolutely staggering reality. Amazon Web Services, AWS, which is their core cloud growth engine, surged by a massive 37%. Think about that. In just the second quarter of 2026 alone, AWS generated over $42 billion in revenue. That's Amazon's strongest cloud growth in over 4 years, and they're operating at a massive 39.4% margin. Which brings us to the million-dollar, or, billion-dollar question. Why? Why on earth is Amazon falling? Wall Street is seemingly punishing a company that has this massive, totally accelerating core growth engine. I mean, if their cloud business is growing that rapidly, why aren't investors aggressively buying up the stock right now? What's the catch? Section 1. The AWS growth machine. Demand outstripping supply. Okay, check this out. Amazon's AWS contract backlog recently skyrocketed from $364 billion in the previous quarter to nearly $500 billion today. Customers aren't just showing up for today's needs, they are committing massive funds to future capacity, driving that backlog all the way up to $496 billion. So this demand, it's not just hype. It's actively being locked into hard contracts by enterprise customers and AI developers. But here's the catch. And it's a really big one. What does it actually cost Amazon to serve all that demand? Because customers clearly want way more AWS capacity than Amazon can currently provide. So who pays for all those new data centers? The thousands of servers, the networking gear, the incredibly massive power infrastructure. Who foots that bill before they ever see a full return? Section 2. The massive AI price tag. Building the infrastructure of tomorrow. Well, the answer to who pays for all this capacity up front is Amazon. Amazon pays for it, and the price tag is literally staggering. To fund these AI and cloud constraints, Amazon recently had to raise its 2026 capital spending outlook to approximately $220 billion. Let's just pause on that. $220 billion. To put that into perspective, we are talking about one of the biggest single corporate investment programs in world history. They are literally building the physical foundation that artificial intelligence depends on, and that requires custom chips, ungodly amounts of electricity, and vast sprawling data centers. Now, as you can imagine, when you casually spend $220 billion, it kind of heavily impacts your financials. Just a year ago, Amazon had a positive free cash flow of $18.2 billion. But in the latest quarter, because of this massive, preemptive spending ahead of expected demand, that completely flipped. It flipped to a negative $7.6 billion. That is a massive, massive swing in cash. Think of this strategy sort of like building a gigantic factory just because customers have already promised to buy your goods tomorrow. It's a 3-step process. Step 1, you've got to spend now. You're laying out billions of dollars up front. Step 2, you build the capacity, actually getting the physical infrastructure in place. And step 3, you finally get the revenue later, once the factory's actually up and running. So your cash flow looks terrible today, even though your long-term economics could potentially be fantastic. But, and this is a big but, it only works if that expected demand actually shows up. And this right here is exactly why good results do not automatically equal a good stock. It's wild, but sometimes a truly great company can report incredibly strong growth and the stock still falls. Why does that happen? Because the market doesn't just price today's earnings, it prices expectations for tomorrow. If investors start to believe that the expectations, and especially the sheer capital cost required to achieve those expectations, have gotten a little too high, well, the stock price is going to feel the pressure. Section 3. Bull, Base, and Bear. 3 scenarios for Amazon's massive bets. Okay, let's break this down. We'll start with the optimistic view, the bull case.
In this scenario, AWS is already growing at 37%, backed by that incredible $496 billion backlog. AI demand remains incredibly strong, and Amazon has the unmatched scale to actually spend that $220 billion better and more efficiently than almost anyone else out there. If those investments generate strong returns over the next several years, today's high capital expenditure is going to look highly rational in hindsight, and Amazon's dominant market position will be totally secured.
Then we have the moderate scenario, our base case. Here, AI demand stays perfectly strong, but Amazon's free cash flow remains under pressure temporarily while they physically build out all this capacity. Investors in this scenario, they simply have to endure a slightly uncomfortable period of lower near-term cash generation. Amazon isn't broken here by any means. They're simply spending ahead of the opportunity. And eventually, those investments will absolutely begin generating the expected revenue and cash flow.
But finally, we have the risk scenario, the bear case. What if AI infrastructure demand actually proves slightly less durable than we all expect? What if cloud customers start optimizing their spending and suddenly overcapacity hits the market? Guys, $220 billion is a massive amount of capital. If the return on investment for that capital disappoints, it would severely pressure the stock's valuation, even if AWS manages to keep showing decent top-line growth.
Section 4, the real metric to watch. Looking past the daily stock price. Now, we really need to notice the vital distinction between future demand and actual recognized revenue. Having a $496 billion backlog absolutely proves immense demand, no doubt, but it does not automatically equal $496 billion in profit, not even close. It requires massive spending, absolutely flawless execution, and a whole lot of time to convert those signed contracts into actual tangible money in the bank. So the absolutely crucial takeaway here is exactly this. Backlog is not cash. It's a lasting financial lesson that, honestly, it's pretty easy to forget right in the middle of a massive tech boom. Contracts must be fulfilled, physical data centers must actually be built, and billions of capital must be spent before any real bottom-line profit is realized. Amazon still has to actually earn a return after spending all those billions to support these contracts. Let's just summarize the core contradiction of this entire explainer by looking at these verified numbers. Amazon stock dropped 2.16%, even though AWS grew a super impressive 37%, and their backlog hit $496 billion. Why? Because their 2026 CapEx, that massive capital expenditure we just talked about, was raised to roughly $220 billion, dragging their free cash flow down to negative $7.6 billion. Essentially, Amazon's growth engine is accelerating rapidly. For sure, but the sheer financial cost of building that engine, it's accelerating right alongside it. Which leaves us with a massive, pretty provocative question to ponder as we wrap up today. Who actually wins the AI boom? Is it the companies building the chips, or is it the cloud giants like Amazon selling the actual compute? Amazon has literally committed $220 billion to ensure they are the ultimate winners here. Whether that massive backlog turns into historic, high-margin cash flow, or a really costly lesson in overcapacity, well, that's exactly what you should be watching in the quarters to come. Keep your eyes on the numbers behind the numbers.